It's 25 to 5, 2CC on a Friday afternoon, and you know what that means. It's time to welcome into the studio Big Luke Smith from Envision Financial. Good afternoon.
Mate, good afternoon. How are we?
Today you've brought a bodyguard.
I have. He's even turned up with the same uniform on, so I'm very impressed.
Yes, you're both wearing the exact same shirt, which of course is vital information for radio listeners who can't see that until I point it out.
And we were laughing at the irony of that a little earlier, so yeah, what are the chances? But you know what? Good taste.
Of
what
course,
can I say?
There is also video of this encounter, which people can check out online later on if they want to see you wearing your identical navy blue polo
Hey, don't say we don't try.
No, exactly. Today we're talking about what is deductible and I guess what is not deductible when it comes to your investment property.
Yeah, look, exactly right. And this one is a perennial top 5 in the questions that we get when it comes to investments. So I thought getting Paul in, who's an accountant. Now Paul's from the firm, they're in Braddon. This is his wheelhouse. So
Sorry, what's the name of the firm?
The firm.
The firm. That's very inventive.
So I thought, you know, great of him to give up his time on a Friday afternoon, which would have been a hard sell. But to get, I guess, to use a better analogy, from the horse's mouth, the things that we get asked all the time, like, you know, what can I claim? How do deductions work? What's the benefits of it? How do you deal with it? What's depreciation? We're going to touch on a few of those things today just to sort of lay out the basics, because there's one thing everybody in Canberra loves, and it's buying an investment property. So making the most of the tax outcomes is obviously important to get the most out of your return.
Okay. One of my fundamental questions on this front, of course, is that how can investors know the difference between what is a deductible expense but what is a capital expense? Because obviously people might go to great expense thinking, I can claim all of this, only to discover, no, you can't.
No, yeah, that's right. Yeah, so it's one of those things with investment properties. You need to have a connection with your income, and there's a big difference between what is a repair and what is capital. So my advice on that would be to, before you go out and do a renovation or do something, is get advice, whether it's talk to Luke, talk to me, talk to your accountant, get advice around what you should be claiming, what you should be, before you spend your money and realise you can't claim something. It's best to be able to get that advice first and then work out what, from a tax point of view, you can maximise your tax deductions then.
Okay, but if something is ruled to be a capital expense, while you can't use it as a tax deduction at the time, that changes your capital base later on for capital gains tax, doesn't it?
Correct, yes, that's right. So in terms of, from that perspective, if you can't claim something as a deduction straight away, that extra cost will add to your cost base for capital gains tax purposes. That's obviously something that's going to come into play when you sell the property. But from a tax perspective, most people would like to be able to claim it as a repair straight away because they'll get the immediate tax benefit. But if you can't claim it as a deduction straight up, you will be able to add that to your cost base. So it will come into play when capital gains tax rears its ugly head when you sell the property.
Indeed. Now, is there a grey area where, for example, there may well be damage to the property and you decide, good opportunity to actually make it better than it was before?
Yes, that's a question I get asked very, very regularly. So usually what happens, and you might see it with a real estate agent ad, might say renovator's delight. And so people buy a property that is maybe, for the sake of an argument, a 6 out of 10 property, and they think, well, let's try and get a little bit more in rent, and we'll paint it and we'll improve it. We'll put a new kitchen in before we get tenants in. And so those costs associated with improving the property, they aren't deductible on day one. You need to add them to your cost base for capital gains tax purposes. A repair is something that is due to wear and tear as a result of tenants. Think about things like scuffing the walls and repainting after the tenants have been in there, recarpeting it after the tenants have had wear and tear on the property. So those sorts of expenses are deductible expenses as repairs. The improvements, things that you've improved the property from a 6 out of 10 property to an 8 out of 10 property, those things are going to be capital.
Yeah, it's still a bit of a grey area to me though, because if you simply repair the things that are broken, that automatically elevates it from a 6 out of 10 to an 8 out of 10, because brand new carpet is so much better than tatty old carpet.
Yep.
So would it then be fair to say, if we had an example for the listeners, I've bought a house for $500,000. Let's imagine you can still do that. Let's say I bought a house.
There are some parts in Australia where you can,
yeah, not
just
in Canberra.
not here.
So I buy a house for $500,000.
Yep.
I throw a pool in. I spend $100,000 on that pool. So I'm living in the place, and 5 or 10 years down the road, I sell it for $1 million. whereas my purchase price was $500,000. As you've said, those sorts of things are not deductible from an income perspective. That then brings my cost base of the house up to $600,000, and we work out our capital gain $600,000 from $1 million, which is what you're talking about, non-deductible immediately. Is
Correct.
that a good example?
Correct. So if in that instance, if you spent $100,000 on a pool, something like that, that would definitely be a capital expense. Most people wouldn't be putting a pool into an investment property. A lot of the things we see would be to improve a bathroom, fix up a kitchen, those sorts of things. Yep. But the same logic applies.
Yes.
So if you are improving it from where you bought it, that's a capital cost.
Right.
If you are repairing it because the tenant has put a hole in the wall or you need to repaint it, those sorts of things would be an immediate deduction, claimable in your tax return that year.
Okay, all right. I think that's good for the listeners to be able to separate that, and I think the big takeout here is find out what you can and can't claim so that there aren't tears at the end of the exercise. So if we elaborate on that a little bit and say, okay, we've done our improvements and we've considered the maintenance and the general expenses to keep a property going, like repainting some walls, redoing some carpet, fixing a broken sink because the tenants have left. Talk to us about how depreciation is caught in the tax return, because I find that one's a surprise to some people when they go to sell and find out that the depreciation lowers the cost base in the opposite way that the capital items have increased the cost base. So can we just touch on how depreciation is caught up in the tax return and what it does at the time of sale?
So when you buy a property, you are essentially breaking it up into three components from a tax point of view. You have got a block of dirt, which is your land. You have got the bricks and mortar of the property, the roof, the walls, and the like. And then you've also got the inside of the property, the carpets, the curtains, the dishwashers. So essentially you've got three components of it. The land, there's no depreciation on the land. The bricks and mortar, we can claim some depreciation on that. And the carpets, the curtains, the ovens, all those things inside the property, we can also claim depreciation on those things. So from a depreciation perspective, in your tax return each year, you claim depreciation, and that's helping increase your tax refund or lowering your tax payable. But when you sell the property, the depreciation that you've claimed throughout the years that you've owned it reduces your cost base. So to give that in a practical example, I'll give a real world example. I won't mention any names, but the worst one I've seen, is I had a client who had bought a property for about $300,000 many years ago now. $300,000, and it was a serviced apartment, and the depreciation rates on that were a little bit higher than normal properties. The client, over about 10 or 11 years, claimed about $100,000 worth of depreciation. The carpets, the ovens, all those sorts of things, and the bricks and mortar of the building. So they claimed about $100,000. The serviced apartment didn't grow in value. He sold it about 10, 11 years later for about $298. So it was a very, very small capital loss is what he thought. When I've gone to prepare the tax return, his cost base, instead of it being $300,000, which is what he thought it was going to be, was about $200,000. So I had to try and explain to the guy that he had a capital gain of about $100,000 on a property that he actually, on buy versus sell, in his brain, lost a couple of grand. Right. So it's always an important thing that speaking to real estate agents, they will sell you the dream of, yep, you can claim good depreciation, and that's great, you can do that, but it's also important that the depreciation return, the cumulative effect of that is it's reducing your cost base from a capital gains perspective and can bite when it comes time for capital gains tax when you sell.
Yeah, so would it be smarter then not to claim that depreciation?
No.
Without now you've really made the water.
Okay. I think the message here is bad is just bad.
No. So I won't bore you with the complicated maths of it. If you want to learn about the complicated maths of it, come and see me in the office. But the maths of it says it is still a good idea to claim depreciation each year. It helps each year when you claim your tax, when you prepare your tax return. But it's important to know that there's this kicker at the end when you sell the property that it will affect your capital gain cost base. So,
I think that's the big takeout here is understand what you're getting into, because I find that is one that surprises a lot of people when they come to me to say, right, I'm going to sell this house and throw the money into super. I said, well, that's great, but go and speak to your accountant about the depreciation, because what you thought you paid for the place may not actually be the case on paper. So it's vital that people understand the implications of the decision they're going to make prior to making it, because what the lads say down the pub about capital gains and everything else may not be the case for the sake of the examples that Paul's given us today. And it's very frustrating to see people come, especially to me, after the fact and find out, like in that example Paul's given, that the tax implications were far worse, or it may have been better waiting 12 months or selling the property in a year after you've retired to manage your broader tax position when you look at the asset in totality. So I think the big thing for the listeners is make sure you're aware of all of these considerations before you pull the trigger, because there can be tears, and they won't be mine and they won't be Paul's. They'll definitely be yours, and if you can avoid them at all costs, it's worth being informed.
Well, the simple solution to capital gains tax is just don't sell it.
Well, that's true, but then you also need to keep partners happy and live off some money and a range of other things. So yeah, I guess the big message is be informed and understand the difference between what is deductible and what is capital. I think we've given some very broad examples of that today.
There's also a list of regular items that I think most people understand are deductible, things like your body corporate fees, your various other costs that you have. But it still might be a list that confuses some people. So what should people remember about those regular costs?
Those regular ones. So the ATO's got some good paperwork and documents on that in terms of what's deductible, what's not deductible. But the common things, the rates, the body corporate, land tax in the ACT is a big one. So all properties that are rented in the ACT should be paying land tax. And if you're not paying land tax, ACT Revenue Office will get you. They will catch you. There's a lot of data sharing between the tax office and state revenue offices. So if you're not paying land tax on your rental property, you should be, and the revenue office will catch you. But so land tax, interest on loans, that's a big one.
Yeah.
Before you buy the property, speaking to a good mortgage broker who understands how investment properties should be financed and structured, that's critical. Don't just go off and do it yourself. Speak to someone and get advice around it. In the ACT, we've got leasehold land. So in terms of from a tax deduction point of view, in the first year that you buy a rental property, legal fees can be claimed as a tax deduction. Also stamp duty, so which is obviously a significant cost when buying a property. In the ACT, we can claim our stamp duty because we've got leasehold land. Everywhere else in the country, so all you listeners in Jerrabomberra and Queanbeyan, no deduction for stamp duty and legal fees over there. But in the ACT, stamp duty and legal fees would be deductible in year one. On how that works everywhere else in the country, so if you've got investment properties somewhere else, those costs, stamp duty and legals on day one, would be added to your cost base for capital gains tax purposes. So again, you do get the credit for them, but just when you sell them, you sell the property.
And again, I think that's important to understand, as we said earlier. I'm going to add a pool, I'm going to improve something. It's treated the same outside of the ACT for stamp duty and those sorts of costs where they're capital and not income. And I think that's, again, understand what you're doing, make these considerations, because if you're going to buy a mucho expensive place and think you're going to claim the stamp duty in Jerrabomberra and you've just paid $2 million and find out that you can't get an income deduction, it can be rather frustrating. It's like buying a house in a self-managed super fund and using your own money as a deposit. Big no-no. You don't go and set the fund up later. So be informed before you make your choice or before you pull the trigger on a decision, so that there are no surprises, because income and capital are very, very different.
On 2CC, it's about 11 minutes to 5, and I've got Luke Smith from Envision Financial in the studio today, and special guest Paul Glass from The Firm. We're talking about what is and is not deductible for your investment property. And of course, the whole point of this discussion is your tax, isn't it? So what happens and what should people do when it comes to tax time? Well, what preparation do they need to make before they come and visit you?
Be prepared. The first thing I'll say is don't bring it in a shoebox.
Oh, why not? I love the shoebox.
No accountant in Australia likes a shoebox. They shudder when they see a shoebox. So in terms of how to prepare your documentation, if you are renting your property through a real estate agent, some people will like to do it themselves because they're a bit more hands-on. Others will outsource it to a real estate agent to manage it for them. If you rent it through a real estate agent, they will give you an annual tax statement. They will give it to you in early July, just after the end of the financial year. So that's the starting point of all your income and any expenses that the agent's paid on your behalf. Then we're sort of looking at other things that you have paid for personally. So things like insurance, you might have paid body corporate yourself. Sometimes the agent will pay for things on your behalf. Sometimes you'll decide to want to pay things out of your own pocket to just manage your own cash flow. So obviously anything that the agent hasn't paid, we as the accountant need to know those things. So it might be the rates notices, it might be the body corporate notices. A good summary of things is important. So the more work you can do in summarising stuff, the easier it is for the accountant, and to be frank, the less it's going to cost you, the more efficient the job's going to be.
There you go.
And obviously everyone likes to save money. So interest on home loans, so the bank statement showing how much interest was charged on the loan for the property, that's important. The depreciation schedule, so that's a one-off. So you would get a depreciation schedule when you buy the property. You'd get a quantity surveyor to prepare a tax depreciation schedule for you. Give that to the accountant. They will put that into their tax software, and that will carry forward each year. So you don't need to get a depreciation schedule each year. So that's a one-off. But the more organised you can be in summarising your documentation, the better it's going to be from a tax perspective, and it's more seamless from the accountant's side.
So once I've got all my documentation properly sorted, properly annotated, all organised and in a nice neat bundle, can't I still put it in a shoebox?
You can if you want.
Very good, thank you.
If that keeps you happy.
It's just a great, easy way to transport it.
And on that note, Paul, where can listeners get a little more information if they want to reach out?
So best bet, thefirmonline.com.au. We're located in Braddon on Torrens Street. Phone number of the business 0262473555. So if you want to make contact, feel free to, and we can help you out with your tax and rental properties.
Yeah, look, and I think that's important because people need to get organised and be prepared. And whilst, people generally leave it to the last minute, understanding what to collate during the year can make that panic at the end of the financial year be a little bit easier, a little bit less daunting. And if you're progressive during the financial year, it can be a little bit easier.
Absolutely. Well, it's the old Boy Scouts motto, isn't it? Be prepared.
Correct.
Exactly.
Absolutely. Be prepared and always do your best.
All you can do.
Those are the two.
All you can do.
All right, Luke. So if people need to get in touch with you, what do they do?
Yeah, our number hasn't changed, 62604749. We've got envisionfinancial.com.au. That's our website. You've got the Knowledge Centre in there. People can subscribe to that for free. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. And we've got the YouTube channel. So you can subscribe to Envision Financial Canberra on YouTube. And we've got all of the shows there. You can watch them on your iPhone. And if you've got a topic you want us to raise early in the new year, shoot us an email, luke@envisionfinancial.com.au, and we can try and build that into the schedule.
Indeed, and on those YouTube videos you can check out what shirt Luke is wearing.
And you can prove that it was a coordinated effort by a complete accident today.
Absolutely. Paul, Luke, thanks very much.
Pleasure. Thanks, mate. See you,
And Luke will be back with us once again at the usual time next Friday afternoon to talk finances once again. News is next.